The point is trying to encourage investors to let markets work on your behalf. The stock market is an amazing invention. It allows entrepreneurs who have terrific ideas but no money and match them up with people who have no ideas but money to invest, and they make a deal. And what we've seen over centuries is that human ingenuity is a wealth engine. And investing in a low-cost, diversified portfolio of stocks is the most reliable way to capture that human ingenuity and put those forces to work on your behalf.
Welcome to The Informed Investor, the podcast that brings you research and insights to help separate the news from the noise.
Welcome, everybody, to The Informed Investor. Today, we are going to look at the lessons learned by analyzing headlines over the last 50 years. The show is brought to you by Dimensional Fund Advisors, who is bringing financial science to investing. Now, today, we have a very special show, a very special guest. We are going to honor our longtime colleague and good friend, Weston Wellington, who just recently retired from Dimensional. And so I'm Mark Ochner, and it's a pleasure to introduce Weston Wellington. Welcome to the show.
Great to be here, Mark.
And we're going to dive into your career here in a second, but I also want to welcome Scott Bosworth.
Thanks, Mark.
Good to have you back
here
on the show. You were
Always
here. Your first run was, we did an episode on investor behavior, which I think is still one of the most viewed shows we've done. So congratulations on that.
Appreciate
we have
it.
high expectations for a repeat for your attendance today.
Well, that would be nice, but I think the real draw today is the legend sitting next to my right here, Weston Wellington. So it's been a pleasure to work with you for all of my only 30 years at Dimensional, but you're 31 years at Dimensional.
31 and a half, I think, if we're being completely accurate.
And over 50 years
Over
in the
50
industry.
years in the industry, yes.
Well, congratulations on retiring. That's a special milestone for you. But your legacy here at Dimensional will be long-lasting.
Well, absolutely. And, I guess we kind of gave it away, but if the audience was watching and wondering, I wonder which one recently retired.
Yeah. You can't get any letters in the mail for violating the dress code anymore since you're not an employee. But I like the badge that you have in the vest. I think you do have to turn that in, though, Weston. So
I think so, too. So this is the last gasp.
We wanted to prove he was a legit employee here. But Harley Davidson, tell us a little bit about that.
Well, I've been riding motorcycles for decades. I got my very first Harley, big touring bike in 1995, and I'm a serial offender. I've had probably 15 or 16 different Harleys and a number of other bikes, and there's always some reason why you can explore something different. So I'm enjoying the prospect of long highway rides in the future.
Would you recommend that be an effective part of somebody's financial plan?
Well, I wouldn't call it part of their financial plan, but you want to be able to plan to be able to enjoy the wealth you've created. I think you should have a goal not just to accumulate wealth, but figure out how you're going to enjoy spending it and not stress about it.
Love it. All right, Weston, one of the things that this show is based on was really inspired by you. What we do on The Informed Investor is we usually start out with a couple of headlines, some very optimistic about what's going on in the world, some very concerning what's going on in the world, and we just sort of banter back and forth and give some thoughts around that. So walk us through how you inspired that for us, Weston, some of your background here and the things that you've done in your career and the way you think and sort of track headlines.
Well, I think of myself as a financial historian. I'm a history major. I'm not a finance or economics guy. Don't ask me to run regressions or compute t-statistics. But I was doing a version of this talk, the talks I give at Dimensional, even before I joined. So I was a director of research for a number of years at a once small brokerage investment management firm, now a very large firm. And I was tasked with being a speaker at these conferences where several hundred representatives would show up. And perhaps because I was a history major, when I listened to so-called experts telling us what would happen the next year, I would take notes, write down what they said. And often the same person would come back the following year at another conference to make another presentation, and I'd say, what did he or she say last year? And I realized after a while that they've got no special insight. They're guessing like the rest of us. But I also learned if you sound really confident and have an interesting story, people want to believe that somebody out there can predict the future. And I think this goes back as far as human civilization, the oracles in ancient Greece and so forth. We hunger for someone who can explain a confusing reality. But if we're being rigorous about our approach to investing, and I think we ought to be, we have to hold these so-called strategists and experts accountable for what they say and figure out, is this a good use of my time and resources to pay people, whether it's a magazine subscription or attendance at some conference or whatever, to tell me what might happen when they're just guessing like the rest of us? Doesn't mean they're evil people. They probably sincerely believe that these forecasts will be helpful, but the evidence is it's not. And if anything, we penalize our future wealth the harder we try to predict the future.
Well, what you mentioned, you do several talks at Dimensional, probably the longest running talk and probably one of the most impactful talks you've given is what we call the Big T's.
The Big T's.
From that. So Scott, walk us through some of that and I guess the lessons learned that from your perspective on.
Well, I mean, I like what you just said. It's like your future wealth, right? Your future wealth could be damaged by reacting or trying to find that crystal ball. And I think you've done a better job than anyone at Dimensional in sort of like unpacking that truth through all of the stories you've told, the anecdotes you've told. I think you would refer to yourself at presentations as the chief anecdotal economist.
Master of anecdotal evidence.
Master of anecdotal evidence. Well said. But yeah, the Big T's. I mean, I remember that article. It was very formative for me in listening to your talk. One of the first times I listened to it when I was at Dimensional. And so what was that article? It was...
Well, it was written by Jane Bryant Quinn, who I consider one of the more responsible financial journalists. And she essentially scolded her readers for indulging in what she referred to as investment pornography, shameless stories about performance that tickle our prurient financial interest.
You know, I don't know what that means.
Yeah. We'll keep that under the cover there. So, and I said, well, this is a sensible approach. And I like this title here, The Big T. So I kind of ran with that. And I was already collecting all this ammunition, as it were, about failed forecasts. And so I would typically highlight some of the more egregious mistaken forecasts, whether it was some terrific company you needed to buy and the shares cratered, or some extreme market prediction up or down that didn't come true. And I would eventually weave this into a talk of 30 to 60 minutes. And as the decades rolled by, it got longer and longer. And it was just sort of a timeline. Here are all the reasons why you might have sort of fallen off the wagon, so to speak, jumped out of the stock market, hoping to get back in at a more favorable time. And if you just sat still and got the market rate of return over that long period, you would have been much better off. Does it mean that no one can beat the market? No. But what we is a huge amount of academic evidence on this particular topic. Yes, there are people, fund managers, money managers, who have delivered rates of return that are higher than the overall broad stock market over some time period. But if we give 5,000 monkeys darts to throw at the Wall Street Journal and let them pick stocks, we get almost the identical result. Some number of monkeys are going to look really good. Now, hopefully no one in this audience think we need to find a clever monkey to manage their portfolio. They just got lucky. Does that mean I can prove that every money manager who outperformed the market just got lucky? No, we can't say that. But what it means is that it's far more difficult to identify truly gifted money managers than most investors think. As I like to say, by the time we can identify a money manager who delivered sensational results, and we can be confident in our assessment that it wasn't just luck, we'll be dead.
Okay. Well, one of those managers that we got asked about quite a bit over the years was Bill Miller. Mm-hmm. Remember Legg Mason?
Legg Mason,
and he
Value
beat
Trust,
the S&P on a calendar year basis 15 years in a row.
No one had ever done that before. And to the best of my knowledge, no one since.
And then what happened, though? After that like years 16, 17, 18, I think he was one of the worst single
One of the
managers in the
very,
country.
I think, I don't know the exact numbers, but he was somewhere in like the bottom 5% out of, many hundreds and hundreds of money managers. Well, did he, what do you make of this? Did he suddenly get stupid? That doesn't make any sense. Does it mean he was just lucky before? You just can't say.
Yeah.
Hey, going back to that talk, to the big T's, let's talk about some of the favorites. Scott, I know you have some favorites. I've got some. We'll start with you, Weston. Do you have one of those examples that really stood the test of time that you've loved over the years?
Well, there are a couple. I remember Money Magazine telling us that when the new iPod from Apple had just been issued for the first time, they had a comment saying, "This is a terrific little gadget. We just bought one. We love it. You should buy one too." But they said, "Now, if you're thinking about buying Apple shares as an investment idea, forget about it. Top executives are leaving the ship. Their software is incompatible with the rest of the industry."
And didn't they pan the idea or the strategy to open up Apple stores?
Yeah, they said these new retail stores Apple is opening up. What a dumb idea that is. They can't possibly sell enough little gadgets at these expensive downtown locations to cover the rent. Go ahead, buy an Apple gadget. Forget about the stock.
We could make fun of this all day, and I guess we will. That's kind of what we're doing here. But I think you said it. They have a job to do. Making predictions is what they're paid to do, and so they're going to do it. And if people stop buying the magazine, I'm sure they'll pivot. But people I say magazine. Maybe that's a little bit of a dated reference. People are getting their
online
financial news from lots of different sources, but magazine subscriptions are still a part of that equation. But so in this spirit of, acknowledging that, one of my favorites of all time, I don't remember the publication, but they had amassed expert stock pickers, economists from all the big, wirehouses and banks, all the usual suspects. And they had asked them for their single best stock pick, I believe, but also asked them for their single worst, like their one stock they thought was going to do horrible the next year. And then in your reveal in the Big T's presentation, you say, actually, their stock picks did pretty well. They beat the market over the preceding
10 stock picks each, 10 winners and 10 losers.
Yeah. So each person got to pick 10 winners and 10 losers. So they aggregated the winners list, which beat the market.
Yep.
But then you reveal that their losers list, their dog list, actually beat both the winners list and the market.
Exactly.
And I believe
the single best performing stock.
There it is.
Among all 500 firms in the S&P index that particular year happened to be Valero Energy, the oil refining outfit. I think the shares were up like 128% just that year. But it was among the 10 stocks these experts told us would have the very worst returns.
So there's no investment advice there other than maybe to don't put a lot of stock in that, no pun intended, in those forecasts. But it is kind of fun to, I think you would call it the wine cellar approach. Obviously when the article comes out, you don't know what the result's going to be.
Right.
You have to wait a year or maybe longer to see how it ages.
So Scott, that's a great example of how in Weston's talk, he looks at some of these experts and how well their expert opinions are. He also gives some great examples of some of the recommendations on individual stocks from these magazines. So here's my favorite that I remember from your Big T's talk. And in this particular issue of the magazine, this was in December of 2001.
Which was a tough year for the stock market.
That was a tough year for the stock market.
Big meltdown in tech and telecom stocks. People were hungry for, safer ideas.
Yeah. So a tough year in the market that year. And this particular magazine is calling this stock America's safest stock.
Not a safe stock. The safest
stock. As close as you'll get to owning an invincible earnings machine. So at the end of 2001, it was trading around $80 a share. By the fall of 2008, it was trading less than $1. And now it's bounced up to somewhere around $6 a share. So Weston, walk us through that. The safest stock.
So you managed to lose not all of your money, but most of your money in the safest stock in America. Now, if this isn't an advertisement for broad diversification to reduce your risk, I'm out of bullets.
Have we revealed the name of the company?
Oh, did I forget to say it was Fannie Mae?
Yeah, I like
Sorry.
I like that you had us all hanging in suspense there.
I messed up. It was Fannie Mae. Which,
Yeah.
when you do the talk,
Yeah.
people start chuckling that remember that. Because,
Yeah, if you lived through the global
Yeah.
financial crisis of 2008, you remember the name Fannie Mae, amongst others.
Yeah.
But I mean,
Yeah,
maybe
so
it weathered the
mention that.
.com better, but the global financial crisis of 2008 really wiped it out.
Weston, do you have a favorite?
Well, the other one I would bring in, it would be Amazon. There was a cover story in 1999, as I remember it, in Barron's, and the cover had a great illustration. It shows basically like a bomb with a fuse lit and about to blow
remember.
up, with Jeff Bezos' face kind of sketched into the bomb, and it said Amazon.bomb.
Catchy.
And it basically said that, there's nothing special about Amazon. They're just another link in the retail food chain. They don't originate any new products, develop anything. They're just a middleman. And whatever they do can be easily copied. So you should be owning companies like Bertelsmann in Germany or Sony, people who originate clever ideas. So now, to give Barron some credit, the stock did go down somewhat, quite a bit actually, after that cover story
Amazon
appeared.
lost, I think, 93% of its value from its IPO in the .com, and then it's obviously
So you can say, yeah, they were
quite a
right,
bit,
but
as has Jeff.
they were still wrong.
Yeah.
Depends how you want to interpret
Yeah.
it.
Well, didn't Apple go around 18 years or so from the IPO until he got back
Apple
up
also
to-
has had long periods of subpar results.
Yeah. All right, Scott, what about Death of Equities? That's an all-time classic.
Been referenced by many other, pundits and even Business Week has revisited that famous or
They did.
infamous cover story many times. But yeah, that I love how you set that up though with the anecdote of the client coming in, you're the advisor, and you have this conversation with them. Walk us through that.
Well, I suggest, so you have perhaps you're a financial advisor and a client comes into your office waving this copy of Business Week in August of 1979, saying, you've been telling me I need to have stocks in my portfolio and never to sell them ever. This article makes a lot of sense to me. It's been a long time, and my neighbors are making more money in bank CDs and T-bills. I think we should sell everything. You, the advisor, say, no, let's not be hasty here. I know it's been a tough time, but trust me, things are going to turn around. Well, how much longer do I have to wait? Well, truthfully, the advisor says, I really can't say, but I think a year, 2 years, I think 3 years at the most. We're going to see a much more rewarding environment. You say, I'll be watching you. Client comes back exactly 3 years later. It's August 12th of 1982. Still waving that copy of Business Week. Time's up! Where's the Dow Jones Industrial Average at that time? It's about 100 points lower than it was 3 years earlier when Business Week talked about the death of equities. Looks like these folks were right, and you are wrong, Mr. Advisor. And don't bother trying to tell me to hold my stocks. I've already phoned the brokerage firm. They've all been sold today. And no thanks for the memories. Stomps out. Congratulations, Mr. Client. You just sold all of your stocks on the very last day of a long, painful downturn in stock prices. And the next day was the very first day of a still unfolding upcycle in stocks. Were you on the train when it pulled out of the station? Or are you still standing on the platform, clutching your copy of Business Week?
That was a very dramatic reenactment, Weston. I appreciate it. I was getting worked up. I was getting anxious.
That's what I do, man.
Yeah. What a performance.
Hey, let's go back to, I guess, some questions over the years. You've been here, 30 years? I've been at Dimensional 28.
I think we're all rounding to the same number at this point, Mark.
Yeah. Well, there's been consistency of
Yeah.
the questions we've gotten over those 30 years, one of which was the Warren Buffett factor. Yeah, but I hear you, Weston, but Warren has it figured out. How do you think about Warren when we get those kind of questions?
I'm a huge admirer of Warren Buffett, but Warren Buffett is not a money manager per se. He's a businessman who acquired this floundering little textile firm, Berkshire Hathaway in New Bedford, Massachusetts, and then proceeded to shoot the lights out over the next, 5 or 6 decades, making acquisitions, disposing of companies. He's not picking stocks. He's running a business, and he's phenomenally good at allocating capital, which is a key skill of any successful executive. Now, I also remember some years ago, maybe 10 years ago now, in his annual report, he mentioned that he had planned to set aside a significant sum of money. I don't think he said how much it was, but I'm sure it was generous, to provide for his wife in the event, he died. And he had instructed the trustees of his will, he told readers of his annual report, that he wanted that money invested 90% in the S&P 500 index and 10% in treasury bills. And I'm guessing he was using the treasury bills just so nobody can say, well, it's silly to have all of her money in stocks. So that was his game plan for his wife. Now here's Warren Buffett. If Warren Buffett can't find the next clever money manager, what makes you think you can find the next clever money manager?
What's your
I love the
story
line,
like,
Wes,
Bud?
and anybody that's heard your talk that's listening to this is going to remember this line. And you were like, if you're thinking about picking some stocks, look in the mirror. I'm going to let you finish
I don't remember that one.
Well, it was like, look in the mirror. If you see Warren Buffett
okay.
staring back at you, go ahead and pick some stocks and give it a shot. If you don't,
That story that has warts on it. It's so old. I've totally forgotten that.
yeah,
but that's a good line. I'm glad you reminded
here for,
me.
Weston.
Yeah. Well,
we're all forgetting more things than we
at
used to
age
forget.
75, there's
yeah.
only so much space up here in the brain cells, and some things have departed.
Yeah.
All right. Another one we get asked about all the time is gold.
Mm-hmm.
And you recently read an article or came across an article that goes back a couple thousand years.
Well, I alluded to an example that stretches back a couple of thousand years. So here are my thoughts on gold. I mean, gold is unique. It's indestructible. It's been valued and fought for centuries. Now, should it be part of your portfolio? Well, if you're a finance professor and you run the numbers over the very long run, and in the United States, we only have about 40 or 50 years of freely tradable gold prices, but it's enough to make sort of an educated guess. The rate of return on gold has been significantly below that of stocks. And part of the reason, the way I would explain it, is that, you take all the gold in the world and you melt it down, you got a big cube, like 90 feet square, and it just sits there. And thousands of years can go by, it's not going to generate anything. So no dividends, no interest, no nothing. So it's always competing with the compounding effect of other investments that do have a reason to grow in value over time. So what I tell people is, look, if you're fixated on gold and you can't sleep at night without having some gold in your portfolio, okay. And for the rest of us, I think it makes more sense to look at gold as beautiful objects of adornment that have fascinated men and women for thousands of years, and get your enjoyment that way.
Well, and I think I've always, when I've gotten this question from advisors or clients of theirs, I often look at it about exposure, right? I mean, gold is, we know what gold is, but gold is an input, right? I mean, lots of companies mine gold. Lots of companies buy gold to put in. I think Apple probably buys gold.
Electronics.
Electronics, automobiles, jewelry. And then you got the mining companies. If you're globally diversified, you have exposure to gold. I think the critical question for investors is that the right exposure, or do you need, for some reason, is your need unique in a way that having direct exposure to this input is somehow beneficial? And I think, to your point, it's the sleep at night thing. If it makes you feel good and you can leave it alone and it's like going to help you.
It helps you stay in the market.
Right. Yeah.
Great.
Then okay. Yeah. But it may not be ideal for most people.
I also suggest that people get weapons training if they're going to have some gold in their portfolio. So somebody might want to come on and steal it from you. And I remember when I was a broker at Bache & Company in Boston, the bank next door, 3 thieves tunneled through something like 2 or 3 feet of concrete and looted every single safe deposit box in the bank, for which there was no insurance. So maybe you had your gold bars in a safe deposit box and you still lost out.
Weston, great walk down memory lane there and some of the examples and stories and things like that. But let's get into then what's it all mean? Like, what's the point of all this stuff and what you're trying to get across to listeners?
The point is trying to encourage investors to let markets work on your behalf. The stock market is an amazing invention. It allows entrepreneurs who have terrific ideas but no money and match them up with people who have no ideas but money to invest, and they make a deal. And what we've seen over centuries is that human ingenuity is a wealth engine. And investing in a low-cost, diversified portfolio of stocks is the most reliable way to capture that human ingenuity and put those forces to work on your behalf. So the more you know about how markets work, I think the more confident you can be that having some portion of your wealth in this approach makes sense for the overwhelming majority of investors. I remember Burton Malkiel, prominent finance professor at Princeton, once said that I think everybody, almost everybody, should have some portion of their assets in stocks. Now, he didn't say how much. Could be only a little. Could be a lot. But whatever the amount, you want to stick with the program.
Well, and you would wrap up the Big T's talk for years, maybe a decade or more, with a story that came out of the dot-com era.
Right.
A woman who had all of her savings, I think, in the company she worked for.
Rose Walcott.
Rose Walcott.
Yeah, it's one of my favorite slides, actually. It's a woman in her mid-50s, and the photo shows her kind of staring off in the distance with a wistful look on her face. And the headline is something like, losses in retirement account, tens of thousands of dollars. Well, how did that happen? Well, she worked for AT&T. She'd been a telephone operator for over 2 decades. And all of her retirement savings and her company retirement plan were in the shares of one company, AT&T. I'm sure she thought it was a sensible idea. She'd worked there for many years. It was the largest telecom firm in the nation for many years. Who could imagine life without telephones? What could be safer? But as I tell investors, the stock market's a wonderful invention. But there's also a dark side that the stock market doesn't know that you have all of your money in the shares of one company, and the stock market doesn't care. It's up to you to protect yourself by putting on the armor of diversification.
Yeah.
Go ahead, Scott.
I was just going to say there was a soundbite that, was inspired by you. It was this idea that because we get this question, I think our advisors do too, where they see clients that have what I'll call a loyalty to a stock that maybe they inherited from their parents or their grandparents. And it's sort of this stock that has taken care of them. And I think you've said, many times I'm attributing it to you, but it was this idea that like you can have loyalty to a stock, but that stock does not have any loyalty to you. It doesn't know you. It's not friends. And things can continue to be just fine, and you might be lucky, but things can also take a turn for the worse, for sure.
Yeah. Weston, you go back to then the challenge for some of the listeners out there. I think all of us as investors, you read these headlines, they appeal to some sort of your emotions, perhaps the anxiety, the fear, sometimes maybe the greed side of things, the FOMO. For the listeners out there, I guess 2 questions. Where do they go to get sensible journalism around markets and investing? First question. And then secondly, as they're reading these articles, what are some questions they can ask themselves to say, does this headline really make sense with how you should be thinking about markets?
Well, I always like to come back to this idea that whenever you see some prediction or some forecast or some strategy that seems to promise a way to outperform the market, it all comes down to you've got to give me a trading rule. What do I mean by a trading rule? Well, it tells me what's the signal going to be to get out of the market. Will it be a prediction that inflation is going to rear up or we're going to have a recession? Well, how do you quantify that? And how much lower does the stock market have to go under some formula where it triggers a rule that says now's the time to buy or now's the time to sell? And that's where all of these approaches fall down. Now, it doesn't mean that there won't be some people from time to time who appear to make a successful prediction. But that's not the game we get to play. It's not enough to be right once or twice. You need to be right over and over and over again in applying whatever signal you think makes sense. So you will read statistics that look like they should be predicting something, whether it's the employment report, the inflation report, you name it. But when the finance professors run rigorous studies trying to find any indicator that works, it doesn't help. One prominent firm a few years ago did a study, and they use a variety of indicators that are often thought to be helpful in predicting stock prices relative to company earnings, for example. And they studied the success or lack of success in all these indicators, and they put in like one dummy indicator, rainfall. Who thinks rainfall in the U.S. is an accurate predictor of future stock market performance? Probably almost none of us. But it turned out rainfall was, in this study, a more accurate predictor of future stock market performance than the majority of the other indicators. And none of the indicators were helpful in outperforming the market. But some were even worse than others. So as tempting as it might be to try to find that one indicator, that one signal that will reliably give us that caution sign, it's just a fool's errand.
I remember Ken French would say, Ken was my professor at business school and has been involved with Dimensional for longer than either of us have. And he would be teaching investments and economics to grad students. And he said, I was always insulted by the people that would leave and go become active managers and try to beat the market. He goes, that's literally what I study as my career. And I'm telling you, nobody can do it. And here you are going like, I'm going to go work for this big bank on Wall Street and, pick stocks for a living. But
it's the classic, but I think I'm the one.
But I think I'm the one, right? Yeah.
I just want one more point. There is some information in all of these ratios, dividend yield, price, or whatever. The question is there enough information to give me a successful trading rule?
Another great quote from you. Well, not from you, but from your talk, which was, the market can stay irrational longer than you can stay solvent. So you might be right that it's overvalued. I think, lots of people predict that the market is at times overvalued or undervalued. But the thing is, those directions can persist for uncomfortably long periods of time. And if you're just rebalancing, you're in a much better like mental zone, I think, than if you're trying to predict this stuff.
All right, let's change gears. That was great. That was a fun walk down some of the big T's and some of our key takeaways and really things that have been impactful for our clients and their clients over time. All right, clearly, I'm going to go into your motorcycles. You love motorcycles?
Yes, I do.
You love cars, fast cars?
Yes, I do.
If you could have any car in the world, dream car, what would it be?
Well, right now, because I would like to drive it, not park it in a glass garage like some of these folks do with their new Ferraris, it would be a Corvette E-Ray because it's wickedly fast, but it has all-wheel drive, so I'm going to be retiring at least part of the year in snowy New Hampshire. So unlike a current Corvette, which is rear drive only, I could drive it in the wintertime.
Of course, it's a practical answer.
A practical answer, yeah. Very practical.
Not like a supercar.
It's only like
or something.
$110,000. Gee whiz.
Okay.
Did you ever see the movie My Cousin Vinny?
Oh my gosh, that was a long time ago.
It was a long time ago, and he's pretending to be an attorney, and then his girlfriend is called on stage, and she's this car, knows everything about cars. Go watch it. My Cousin Vinny. You will love it. It's kind of reminded me of this. What year, by the way, would you like that E-Ray? What year?
Well, they make them right now. It's a new model.
The newer the better.
The newer the better. 2026.
And it's still all-wheel drive?
Oh yeah.
Okay.
Oh yeah.
All right.
It's only the E-Ray only comes in all-wheel drive. It's got an electric motor up front.
Last one. You've been a road warrior.
Yes.
For probably your whole career, but certainly a Dimensional.
Pretty much. Yeah.
How many miles have you logged in your 31 and a half years at Dimensional?
Oh gosh, I have no idea. Hundreds of thousands.
Airline miles. You got to be over 2 million.
Millions.
Yeah. I don't know. I honestly, I can tell you that I probably fly about 125 flights a year. But
31 times 125 times.
I'm
1,500
hoping that
miles a
number
flight.
goes down significantly now that you are.
well, it will.
retiring.
Although my wife and I have a horse ranch in the Central Oregon, and I have an old dairy farm now, wedding venue in northern New Hampshire. So I'm going to be flying cross country, at least every month.
Well, listen, Weston, Dave Butler, who started the same day as you here at Dimensional,
Exact
is now
same day.
co-CEO of Dimensional. He put just a really nice piece together and posted it on LinkedIn about your contributions. I mean, like I said earlier, an incredible impact on Dimensional, our success here in the financial advisor space, incredible impact on our clients and helping them be able to become better communicators with their clients. So thank you for everything you've done for Dimensional. For our clients, for investors out there, I encourage everybody go to LinkedIn and check out that piece. And Scott, there's been just tons of posts from a lot of the clients and friends too.
A lot of familiar names from way back in the day, kind of all like giving you a pat on the back and really just thanking you for all the inspiration they got from your wisdom.
It's been an amazing 30 plus years for me.
Awesome. Well-deserved retirement. Go enjoy it and send us pictures of all your new cars and motorcycles.
Thanks, Weston.
Thanks, Weston.
Thank you.
Yep. And thanks everybody for joining The Informed Investor. Be sure to check out that LinkedIn post that Dave Butler wrote about Weston. And also be sure to check out a book that David Booth, our founder and chairman here at Dimensional, he wrote a book called Stay Calm. It has fantastic lessons about life and about investing. So again, stay calm. Thanks everybody. Have a great rest of the day.